Hello students, today we are going to discuss about GST, Goods and Service Tax. So in this class, we are going to cover what is GST, what are the journal entries to be posted in the books of buyer when the buyer purchases goods from the seller, what are the journal entry posted in the books of seller, and we'll understand what are the different type of taxes under GST. So to begin with, let's try to understand what is GST. Generally, GST is an indirect tax, okay, and mostly it is applied on goods and services supplied by the manufacturer or the service provider. Okay, so let's take an example here. In the given case, suppose there is a buyer and a seller. Okay, the buyer is purchasing goods from the seller. Okay, so buyer is issuing a purchase order, seller supplying the goods to buyer based on the contract. Now what is happening when seller is selling the goods, the accounting entry what the seller is going to post is selling price, for example 10,000 rupees. Okay, and on these goods the GST rate applicable is 18%. Okay, so what is the amount of GST to be collected is 1800, correct? And who is going to pay this total amount? It is the buyer. Okay, so the total invoice value is 10,000 plus 1800, invoice value is 11,800. Now this invoice when received by the buyer, okay, because he is purchasing goods from the seller, right? So this material are treated as inventory in the books of buyer. For example, if it is an inventory, so what is the entry the buyer is going to post? Inventory account debited rupees 10,000 rupees, because that is the cost what he is paying to the seller for the goods, and the amount what buyer is going to pay towards GST. Buyer has to take a call whether the GST what buyer is going to pay to the seller, whether that is creditable. What is the meaning of creditable? That means you pay to the seller, take input tax credit, and whenever the buyer will have GST payable scenario where he collects from his customer, this money what is paid to the supplier can be adjusted with the GST payable amount. That means this amount is treated as an advance tax paid by the buyer, okay, where the seller collect this money from the buyer and remit to the government, and seller has to file GST return quoting the GST number of buyer so that the buyer can take credit for this 1800 rupees. Now if I have to take credit as a buyer, then this 1800 rupees is a asset for me. It is equal to asset, right? Because tomorrow when I have to pay GST tax liability, I can adjust this amount with the liability. That means I can reduce the liability. Hence this is an asset for me when I pay to the seller. So what is the entry we are going to post here? Inventory account debited 10,000, GST input tax debit 1800 to seller 11,800. So anyway we are going to pay 11,800. The seller will retain 10,000 with him because that is the price he is collecting towards the sale. The money 1800 what I am paying to the seller or what the seller is collecting from the buyer, this amount will be remitted to the government of India as tax collected and remitted. Okay, so these are the two entries what will be posted in the books of seller and in the books of buyer. Now this 1800 what is paid by the buyer, what the buyer is going to do with this money? The buyer can utilize against GST payable. So whatever GST payable, that means when the buyer will sell this product in the market, buyer has to collect GST from the customers, correct? At that time, the amount what he collects towards GST from the customer, buyer can adjust 1800 rupees first, saying that I have already paid to my seller, I need not again remit to the government. The difference amount only he has to remit to the government. So we'll try to understand through an example so that we have more clarity. Buyer is a trader. Okay, so buyer who buy it from the seller is a trader. That means trader means what? Buys goods and sells it in the market. No manufacturing, just buy and sell. And sold the goods purchased from the seller to XYZ Limited for rupees 15,000. So buyer after buying these goods sold all the items to XYZ Limited for rupees 15,000 rupees. And what price he bought? He bought at 10,000 rupees. And what price he's selling? As 15,000 rupees. Correct? So making a profit of 5,000. So this 15,000 is excluding GST and the applicable rate is 18%. For example, the GST on this product is 18%. Okay. Now in this scenario, what is happening? The buyer in the previous example changed to the seller. Now he is taking the role of the seller and XYZ is the buyer here. Correct? What is the entry? Now the seller is going to post the entry. So the first entry is XYZ limited account debited. Okay, I'll come to the amount later. To GST payable 2,700, to sales 15,000 rupees. So we saw here, right? What is the selling price excluding GST? 15,000. So to sales 15,000. Company is going to earn this as an income. Okay, but along with 15,000, the seller has to collect 18% GST. So 15,000, 18% is 2,700. Correct? Now, who is going to pay this 2,700? It is the customer of the buyer. Correct? Customer of the seller. 17,700 is the total amount to be collected. Okay. Once this amount is collected, okay, what is the final entry now to be posted in the books of seller? GST payable account debited 2,700. Okay. The money what is collected now the seller has to remit to the government. So GST payable account debited 2,700. So this account which is credit and this debit will knock off, right? So that you are paying the complete GST payable amount. But am I going to pay this 2,700 in cash to government? The answer is no. Why? Because I have already an input tax credit which I have posted entry at the time of buying the material. Correct? That is the amount what is paid to the supplier when buying this material. So this 1,800 which was treated as an asset will be knocked off here to GST input credit. So that asset will become again zero and net amount paid to the government is to bank 900 rupees. 2,700 minus 1,800. Clear? Now let's try to understand a little bit more about GST. Okay. So previous we understood how the accounting entries will flow. Now let's understand a little bit more about GST. So when it comes to GST, the transaction can be classified into two categories, intrastate and interstate. By name intrastate, you can understand that the goods are sold inside the state boundaries. Okay. So for example, if the manufacturing is in Punjab and the sales is happening in Punjab, it is intrastate. Okay. I repeat, for example, if the manufacturing happens inside Madhya Pradesh and the sales is within Madhya Pradesh, it is intrastate. Okay. In case of interstate, the sale is happening outside the state. That means if the manufacturing is in Karnataka and the sale is happening in Tamil Nadu, then it is an interstate transaction. Now question is why we have two different type of transactions classified under GST? Because the tax applicability is different in both cases. In case of intrastate, there are two type of tax, CGST and SGST. CGST is Central Goods and Service Tax. SGST is State Goods and Service Tax. Okay. And here also government has notified four different rates for CGST and SGST. 5%, 12%, 18% and 28%. So government has declared different category of goods on which 5% will be applicable, different category of goods on which 12% will be applicable, different category of goods on which 18% will be applicable and 28% applicable. Now when the company will be issuing the invoice, the company has to split this tax percentage 50-50% among between CGST and SGST. So if the percentage is 18%, CGST is 9%, SGST is 9%. And in case of interstate, the GST to be applicable is IGST, which is called as integrated GST. Okay. Now, as we understood now that there are two different heads, CGST and SGST. Okay. So buyer has to take input credit in these two different heads. Okay. Because you have to maintain two different ledgers. So what is the final entry the buyer is going to post? Inventory account debited, CGST input debited, SGST input debited to vendor. In our previous example, we saw that we wrote one single ledger called as GST input credit, but in real practical scenario, we have to split these two because these two can't be clubbed. Central GST is different, state GST is different, hence the input credit has to be reported separately in two different ledgers. So we'll understand now with a good example so that you will have more clarity on this accounting. Let's take this example. ABC Limited purchased goods worth of rupees 1 lakh. Okay, so ABC Limited purchased goods worth rupees 1 lakh excluding GST from XYZ Limited. So XYZ is the supplier here and ABC Limited is the buyer. GST rate applicable is 18%. So on this material, the GST rate applicable is 18%. Both ABC Limited and XYZ Limited are located in Karnataka. So it is very clear that this transaction is intrastate, within the state, right? So the purchase and sell is happening within one country, within one state. Hence, this is intrastate transaction. Next, ABC Limited sold all items to PQR Limited, same located in Karnataka, for rupees 1,20,000 excluding GST. So whatever ABC purchased from XYZ, goods worth of 1 lakh with a profit margin of 20,000 rupees is sold to PQR Limited. Okay, 20,000 rupees profit. But this product is treated under GST as luxury item, for example, and GST rate applicable is 28%. So what is happening at the time of buying, the percentage was 18%, but at the time of selling, it is 28%. I'm just taken as an example. It may not be a scenario that in traded goods the percentage changes, but for understanding the question or the concept, I have made two different percentages here. Now, let's pass journal entries in the books of XYZ Limited and ABC Limited. So XYZ is the seller and ABC is the buyer, and later ABC also gets converted to seller as he sells to PQR Limited. So let's see what are the journal entries to be posted. In the books of XYZ Limited, who is the seller, ABC Limited debited rupees 1,18,000 rupees. Why this 1,18,000? Sales is 1 lakh. Okay. Now you can see here. Now ABC Limited will be paying to XYZ Limited GST to the extent of 18%, right? Because in the question we saw that the GST applicability is 18%, correct? And that has two portions: CGST payable 9,000, SGST payable 9,000, correct? So after posting this entry, ABC Limited will make payment to XYZ and XYZ will remit this 9,000 plus 9,000 to Government of India. Okay. Now, when XYZ remits this money, ABC Limited gets the right to claim this money as tax credit, correct? Now, what is the entry ABC Limited is going to post when he buys this material? Inventory account debited rupees 1 lakh, which is equal to the sales reported by XYZ. CGST input tax credit. Here it was CGST payable, SGST payable, because XYZ is collecting and revenue to the government. It is liability for XYZ. But for ABC, these are all current assets which will be utilized in future along with the or against GST payable. So CGST input tax is 9,000, SGST input tax is 9,000, to XYZ, who is the vendor or creditor, 1,18,000 rupees. Okay. Now, when ABC is selling to PQR, he is charging a higher highest GST rate, that is 28%, correct? And selling at 1,20,000 rupees. So what is the entry now? ABC is going to post as a seller. PQR Limited debited. How this amount is derived, I will talk later. To sales 1,20,000 rupees. And if you see here, the GST rate is 28%. Okay. So 50% will be towards CGST. 50% of this will be towards SGST, which is 14% and 14%. Correct? 14% and 14%. So what is the amount? 14% on 1,20,000, 16,1800, 16,1800. So PQR Limited is going to pay 1,53,600 to ABC Limited, and here also ABC Limited will file return stating that 16,800 plus 16,800 collected from PQR Limited. And like this, when PQR will post this entry as inventory, for example, in his books, unless he is the last user can't take credit. So that is a different story. Unless he is the last user, he can take credit for these two amount. Okay. So this is the example which gives more clarity how GST accounting works. Another point to give you clarity that if the company is not eligible to take credit, for example, in this point number 2, if the company is not eligible to take tax credit, then the company need not post entry for CGST and SGST input tax, because it is not an asset, because you can't take credit. Hence, in that scenario, 9 plus 9, 18,000 will get added to inventory. Or if it is an expense for the company, it will get added to the expense cost. So any non-creditable item will get added to the actual cost of the asset or to the expenses. But if you are eligible to take credit, then you have to post in the asset ledger, that is input tax credit, and adjust with your GST payable. Hope you have understood the flow of entries. Let me know in the comment section if you have any specific query. I will be happy to clarify that. Thank you.